Every great partnership starts with an idea. But what really gives that idea strength, what allows it to endure, isn't just the concept itself, it's the financial structure holding it all together. It's an agreement built on clarity. And the language of that agreement? Well, that language is accounting. Today, we're going to explore that language from beginning to end.
So maybe you have a venture in mind, an idea you're passionate about. But have you thought about how you'll make sure it survives its very first disagreement? The key to a lasting partnership isn't just the brilliance of the idea. It's the blueprint you draw up from day one. It's a plan that defines what's fair, it outlines who's responsible for what, and it builds a foundation of trust that can actually withstand the test that every business faces.
I like to think of a partnership as a kind of tapestry woven together from each person's skills, capital, and effort. But before you can even pull the first thread, you need a design. You need a blueprint. And in the world of business, that blueprint takes the form of a very crucial legal document. This document is called the partnership deed. It really is the foundational agreement that sets all the rules of the game. Now, sure, a verbal agreement is technically possible, but a written deed, that's essential. It has the power to turn vague assumptions into solid certainties, and it gives everyone involved a clear path to follow. So what exactly is inside this blueprint? Well, you can think of it in three key parts. First, you've got the fundamentals. Who are the partners? What's the purpose of the business? And who is contributing what? Second, there are the finances. How exactly will profits be shared? Will there be salaries or interest paid on capital? And third, there are the what-ifs. This part lays out crystal clear procedures for handling disagreements or big changes, like a partner deciding to leave. Every single clause in there is designed to prevent a future problem.
Okay, so with the blueprint in place, the partnership starts to come to life. Now we step into what I call the engine room. This is the day-to-day financial machinery that keeps the business running. This is where we track each partner's stake in the venture and make sure the rewards of all their hard work are distributed fairly, exactly like the deed says they should be.
At the very heart of this engine room is the capital account. Every partner gets one, and it basically tells the financial story of their journey with the business. It keeps a running tally of their investment, their share of any profits or losses, and any money they might take out along the way. It's the definitive measure of what they own in the business.
Now, partnerships generally use one of two methods to keep track of this financial story. The first is the fixed capital method. This one uses two separate accounts to keep things neat and tidy. One for that stable core investment and a second one, called a current account, for all the day-to-day changes like salaries and profits. This gives you maximum clarity. Then you have the fluctuating capital method. It's simpler. It just uses one single account where every transaction gets recorded together. So really, the choice comes down to a trade-off. Do you prefer more clarity or more simplicity?
So, when the business actually makes a profit, how is it divided up? Well, it's not just some informal cash transfer. It's a formal, structured process. And this is handled by a special kind of statement, the profit and loss appropriation account. Think of it as the official step that makes sure profits are handed out transparently, exactly according to the rules that were set in the deed. So, how does this work in practice? You can think of it as a two-step process that's all about fairness. First, the account pools all the available profit. That means the business's net profit plus any interest the firm might have earned from money the partners withdrew. Then, and this is the important part, before splitting the final profit, it makes some specific payouts first, things like interest owed to partners on their capital and any salaries that were agreed upon. Whatever is left over is the true distributable profit, and that's what gets shared. It's a system designed to reward partners for both their work and their investment before dividing up the rest.
Of course, no business journey is perfectly smooth. Even in the strongest partnerships, financial complexities are bound to pop up. The threads of that tapestry we talked about, well, they can sometimes get tangled. But a well-designed accounting framework, it isn't just for when things are going well. It's specifically designed to help navigate these very challenges, fairly and transparently.
So where do partnerships typically run into trouble? It almost always starts with some kind of ambiguity. An unclear agreement on how to share profits, or maybe a dispute over who put in what at the beginning. And things can get especially tense when it comes to valuing assets during a partner change. Plus, since partners often have unlimited liability, keeping track of shared debts is absolutely critical. Each one of these isn't just an accounting issue. It's a point of friction that can really strain a business.
So how do you prevent these tangles from happening in the first place? Well, the answer brings us right back to where we started. That comprehensive partnership agreement is your single most important tool. By getting rid of ambiguity from day one, it becomes the clear, unbiased reference point for navigating any disagreement that comes up. It is, without a doubt, the ultimate defense against conflict.
All business journeys eventually reach their destination. For a partnership, this final chapter is called dissolution. Now, it's really important to see this not as a failure, but as the natural and orderly conclusion of the venture. It's the careful, methodical unraveling of the tapestry, making sure every single thread is accounted for. This whole process is highly structured to ensure absolute fairness. It follows a very strict pecking order. First, all the business assets are sold for cash. That cash is then used to pay off everyone outside the firm, all the lenders, all the suppliers. Next, any loans that the partners themselves made to the firm are repaid, and only after every single debt is settled is the remaining cash paid out to the partners to clear their final capital balances. It's a methodical process that leaves nothing to chance.
And when the process is finally complete, the business bank account has a balance of exactly 0. That simple number is actually quite profound. It means the story is finished. Every asset has been sold, every debt has been settled, and every partner has been paid their final due. The journey has come to an orderly and equitable close. In the end, you see, partnership accounting is so much more than just numbers and ledgers. It's the architecture of the business relationship itself, a system that's built on transparency and on trust. It is your best defense against disputes. So the real question isn't just about whether you're tracking the money correctly, it's about whether you've built a partnership that is truly strong enough to last.